Good morning. It's Monday, September 29th. I'm Phil Streible, Chief Market Strategist at Blue Lion Futures. So government shutdown risks are really fueling the precious metals, and gold on up to new record highs. So let's check in on the setup here in the S&P 500, the stock market, the precious metals here, with gold soaring about 45% this year, on track to close out third consecutive quarterly gain this week here, with holdings in the bullion-backed ETFs at its highest level since 2022. So what's the next here step for gold? Is it just 4,000? What lies beyond that? Same thing with silver. $50, $60, what lies beyond and where can we go? That's some of the things we'll be dissecting throughout the week, and I'll also be updating some upward projections here in the chart pack. If you haven't done so, register in the link in the description below. Now, stock futures, they are higher here, and sentiment is generally positive at the start of a busy week of data and Fed speakers. We also do have the potential for a government shutdown. There have been about 14 total government shutdowns, 8 under the Reagan era. The longest one here was 34 days back in 2018. At that point in time, the S&P 500 did start its sell-off aggressively and fell about 10%. It was the worst December since 1931. I remember that closely, and we had a lot of put options coming into that, playing more of a downturn in the economic data here and a snapback in the dollar index coming into those early months of the following year, which played out nicely. Now, if you look at Goldman Sachs, they are recommending buying stocks into the end of the year, saying that there's optimistic growth really driven by the AI, the broadening of the market, the small cap rally here, and then dovish Fed expectations are creating this Goldilocks scenario. So you have growth, organic growth within the sector here, within the NASDAQ, that's broadening out, where smaller businesses are also adopting AI and partnering with some of these hyperscalers in order to improve their streamlining, their bottom line, their robust growth here is really starting to take off, and that's where the tailwinds in this U.S. equity rally could really take off here into the year end. I believe that some of these expectations closer to 7,000 on the S&P 500 could be quite probable here as far as playing out. You look at the S&P 500 up about 0.5%, 6733. That's up 36 points. You look at the NASDAQ up 136 points here, up 0.7%, sitting at 24,891. And the Russell up 0.7%, leading the charge higher at 2467. So some key events this week are going to include Tuesday's JOLTS data, which is expected to show a decline in job openings. So the way this works here is when you have a booming economy, you got a booming labor force, what happens? There's more hiring going on, so there's more actual job openings here. When you see a decline in job openings, that's where people are being replaced by AI. That's where companies are really tightening up the belt here, and it's not a good thing for the labor market. That's been one of the key data points that the Fed is watching here. It seems like they've given up on tracking inflation here. They talk about it, but the reality is that we are at this new band here in inflation from about that 3% to about 2.5%. And will we ever achieve 2% or that target again? I don't know here. So Friday's non-farm payroll report, that should be coming out here. And then we're going to have Fed speakers kicking off with Cleveland's Fed Hammock, who's expressed concerns about above target inflation on an interview with CNBC and argued against interest rate cuts. The funny thing about Hammock is that's the most aggressive and most hawkish policy maker, but not a voter on the policy this year. So really discrediting what she's saying. So you look at the latest data here on Friday, we just saw that key inflation gauge. It grew at a slower pace than what was expected here last month, and it gives the Fed some breathing room to really address those labor market conditions cooling off here and helping keep the bet of the rate cuts in play. You had oil and you also had copper on track for its biggest weekly gain in 3 months. That was last week here. Oil prices settling back down about 2% right now, 64.50. We outlined some resistance points in the chart pack there. And then the copper market here getting a bit of a boost here, up just under 1%, sitting at 480. So continuing to move higher on the news about that Freeport-McMoRan mine, taking off some of that supply that's coming out here, with demand holding steady at the moment. You look at your checklist on the health of the markets. This is what I do every day. I'll look at the dollar index. Where's the dollar? Pulling back here. It's right on the screen here. All the foreign currencies pushing on up. I'll look at the 10-year treasury yields, also pulling back from last week's highs here, putting a boost on the 10-year note, pushing that up, providing some tailwinds and a perfect scenario for gold futures moving on up. I'll look at the volatility index. That's selling off almost just about 1%. That helping out, boosting that investing into the U.S. equity markets, with traders not concerned about volatility and volatility coming out of the market here. I'll look at platinum, I'll look at palladium, both green on the screen here. Well, palladium just a little bit lower here, but platinum continued to push out up at 1625. Fresh concerns that the platinum group may be swept into Trump's Section 232 investigation, with higher odds of palladium being subject to potential U.S. tariffs. That's pending a review that's expected to land in October, and that's what helped push up those markets here last week. You look at the copper market, we expect to see grid and power infrastructure really drive that copper demand here over the long run, over a multi-year duration. Copper prices, after that 25% setback, continuing to push higher here over the rest of the decade, with really driven to, that infrastructure, that grid, that power that's going to need to be fueling this AI, this transition here. If you're wondering why, your computer's running slower, your phone's running slower, if you haven't upgraded any of your technology in quite a while here, you're going to continue to see the need to do so as applications continue to add more AI to their programs here. So you look at some sectors in focus. Well, the miners are in focus after Bank of America Global Research, they hiked their copper price forecast as that mine supply comes under pressure, flagging a focus for pure play copper names. They also look at oil shares here, which may be active as crude oil prices are declining in anticipation of another production hike here for OPEC Plus in November here, really adding to those supply glut. So that's why you got crude oil prices pushing lower. You look at the global markets, you had European stocks set for the third straight quarterly gains here as investors are upbeat about the prospect of economic growth, advances in AI, interest rate cuts here, with the miners outperforming and energies pulling back. You sit there and look at Asia trading here. Asian stocks, well, they declined. They advanced. They didn't decline here. They were helped by that rally in technology shares in Hong Kong, South Korea. Looking at the MSCI over here, climbing about 0.6%, with Alibaba and Tencent among the biggest contributors. Looking at some of the other things here, what are the markets looking at as far as the CME's Fed Watch tool and future interest rate cuts? Well, you got a little bit of a decline here. You have an 89.3% chance of a 25 basis point interest rate cut, 10.7% chance of no change. That's been boosting up a little bit, so markets are starting to level off their predictions. You go to the poly market, you got an 81% chance of a 25 basis point interest rate cut, 4% chance of a 50, 16% of a no change. That's been getting a boost here. So traders are really positioning for the possibility of no interest rate cut here. At least those people are starting to form on the surface. And then you look at the ETF flows, where they piled back into the gold market, adding 412,000 troy ounces of gold. You go to the silver market, they actually cut about 1% here. So it's up 14% year to date, cutting about 2 million ounces here on Friday. Why did they cut on Friday? Why did they exit the silver market on Friday? Well, naturally, you get that massive move higher here. They're going to take some profits and they're going to prepare themselves for that Sunday night raid, which we didn't see happen here. We actually saw futures, they gapped lower, then they pushed on higher and they closed out the gap here. So the dip buyers are quite active, and I believe that much of it was those people that sold on Friday. Well, they probably got futures trading accounts. So what did they do? They came in and they bought that dip on Sunday here. That's why it's really important, in conjunction, to have your wealth management account, your physical metals holdings. You always want to have a futures trading account. And I consider a futures trading account also a bit of an insurance policy in case some geopolitical events occur overnight, in case you need to position yourself for a hedge in the U.S. equity markets or something else here. We've seen a lot of this action move, and a lot of these things take place here in the overnight sessions, and that's where futures trading really comes into play. You also have Bitcoin snapping back up about 3%, and again, U.S. equities here driving higher. So if you guys got any questions, reach out. Send an email to info@bluelinefutures.com, and remember that futures and option trading does involve risk of loss and may not be suitable to all investors. Good luck, good trading.